Plug Power beat Wall Street consensus on both the top and bottom lines for the second quarter of 2026.
They really did. I mean, net revenue came in at $178.3 million.
Which completely tops the 168.76 million consensus.
Right. It's like a solid 5.65% beat. And if you're tracking it sequentially, that is up roughly 9% from the first quarter.
Oh, wow. Okay.
Yeah, and it's a 2.5% expansion year over year.
And on the profitability front, adjusted loss per share actually narrowed to negative 7 cents.
Beating the expected loss of negative 8 cents. Right?
Exactly. Though, for those tracking the unadjusted numbers, GAAP EPS was negative 14 cents.
Sure. But looking ahead, management raised their full year 2026 revenue growth guidance.
Up to that 15 to 16% range.
Yeah, up from the 13 to 15% target.
Yeah.
And crucially, they maintained their target of hitting positive EBITDAs by the fourth quarter of this year.
Right, Q4 2026. So the stock reaction, it dropped 3.21% in the regular session right before the report.
But then it popped, what, over 7%?
Yeah, 7.11% in after-hours trading, pushing it up to 2.26.
Mostly as investors, we're just, digesting the beat in that raised outlook.
Right. So you are listening to our latest deep dive, and today our mission is to figure out if this post-earnings pop is the real deal.
Or if it's just a temporary mirage.
Exactly. We've pulled the Q2 report, the analyst notes, the options data, just to cut through the noise for you. Because looking at that 7% after-hours pop, I have to ask, is this a fundamental re-rating, or is this just a relief rally?
What do you mean by relief rally?
I mean, the options market had priced in a massive 13.5% earnings swing, right?
Oh, absolutely. The volatility expectations were sky high.
Right. So with a stock this heavily targeted by short sellers, maybe this is just panic buying. Like the apocalyptic cash burn scenario didn't happen, so short sellers are covering their bets.
That is a completely fair question. Is it genuine long-term buying or just traders scrambling? To figure that out, we really have to look past the headline beat.
Because a $9.5 million revenue beat doesn't move the needle alone.
Exactly. The stock reacted because the actual cost of generating that revenue changed dramatically. Management addressed the market's biggest fear, which is that aggressive cash burn.
Let's unpack the mechanics of that. Because the gross margin improvement is, well, it's the first thing that jumps off the page.
It really is. It improved to negative 0.9%.
They are sitting right on the edge of break-even.
Basically, yeah. And for you listening to appreciate how massive that course correction is, last quarter their gross margin was negative 13%.
Wow.
And a year ago, it was negative 31%.
And if you remember Q1 2025, they posted a brutal negative 55% gross margin.
It's an incredible trajectory. And the operating expenses reflect that exact same tightening. JAP operating expenses fell 50% year over year.
Down to 62.43 million, right?
But wait, let's clarify that. That 50% drop is heavily aided by an accounting nuance.
Oh, definitely. It wasn't just them turning off the lights. It was heavily aided by a $39.7 million recovery of previously impaired assets.
Right, so for anyone who doesn't live in spreadsheets, do they just find a massive bag of cash in a warehouse? Basically, yes. It was mostly a $37 million settlement from a customer contract dispute.
Ah, okay.
From an accounting perspective, they had previously assumed that money was gone, so they wrote it off. When it settled, it got recorded as a massive benefit.
So it's a one-off windfall. Fantastic for this quarter, but we absolutely cannot model a $62 million operating expense going forward.
Precisely. If you strip out that $37 million settlement, the normalized run rate is closer to $75 million a quarter.
Which is still great. That aligns with their Project Quantum Leap restructuring goals.
It does. And their net cash usage, which is the ultimate survival metric, dropped 58% sequentially. They only burned $61 million for the entire quarter.
Okay, so I look at these financials and I think of a leaky bucket.
A leaky bucket?
Yeah. For years, Plug Power was just trying to pour more water, more revenue into the bucket to offset the millions draining out the bottom. Project Quantum Leap seems to finally be patching the holes. But let me push back here. As financial analysts, should we really be throwing a parade for a company posting a negative 0.9% gross margin? They are still literally losing money on every dollar of sales.
It's a valid reality check. In a vacuum, you never celebrate a negative margin. But markets trade on the rate of change.
The second derivative.
Exactly.
Yeah.
When you shrink cash usage by 58% in a single quarter, you radically extend your runway. You buy time.
And investors are suddenly willing to finance that time.
Right, and to understand why, we have to look at the segment data. The core material handling business is hitting an operational tipping point.
Okay, let's look at the actual hardware, the GenDrive unit deployments.
These are the hydrogen fuel cells for massive warehouse forklifts, like for Amazon or Walmart.
Deployments surged 125% year over year to 1,666 units in Q2. And management dropped a massive forward-looking stat, too.
The refresh cycle, right?
Yeah, two major customers are planning to replace over 20,000 units over the next 3 years. That is a massive built-in demand floor.
And that install base is what feeds the most impressive line item in the whole report, which is the service revenue,
It hit $29.8 million this quarter.
up 82% year over year. But it's not just the top-line growth. Service actually generated a positive 27% margin.
Wait, stop right there. That is a huge shift. They turned the repair teams into a profit center.
They really did. For the past year, Plug has been investing heavily in the physical reliability of their units.
So how does reliability flip a margin by that much?
It comes down to truck rolls and operating leverage. When units break constantly, technicians are playing whack-a-mole, driving everywhere doing emergency expensive repairs.
Makes sense.
But when the units become reliable, those technicians switch to predictable preventative maintenance. They can cover way more units per daily route.
Labor costs stay flat, but revenue scales up.
Exactly. That's how you hit a 27% positive margin.
That is the classic razor and blades business model applied to heavy logistics.
Yep, sell the forklifts at break-even to lock in profitable service and fuel contracts.
But let's talk about the fuel side. This is where the razor and blades analogy gets a bit problematic.
Because of the fuel margins.
Right. Fuel margins improved to negative 48%, up from negative 91% a year ago. Management credited better plant utilization, but if fuel margins are still negative 48%, Plug is heavily subsidizing its customers' hydrogen consumption.
Yeah, they are.
So how sustainable is that model if you are literally paying the customer to take the blades?
Well, to understand why that trajectory from negative 91 to negative 48 is a huge win, you have to understand hydrogen logistics. It's the smallest molecule in the universe. It escapes easily.
You have to chill it to near absolute zero or compress it like crazy?
Exactly. The negative 91% margin happened because Plug's own production plants were offline or ramping up, so they were forced onto the open spot market.
Buying expensive third-party retail hydrogen and selling it at wholesale contract prices.
Right, they were getting squeezed on both ends.
Every time a forklift refueled, Plug Power was handing the warehouse manager a $20 bill.
Pretty much. But the improvement to negative 48% proves their internal production network is finally coming online.
Spreading those massive fixed plant costs over more kilograms of hydrogen.
Exactly. They aren't at break-even yet, but the trajectory proves the internal network economics can function at scale.
Okay, so the material handling segment is stabilizing the ship. But stabilizing a leaky ship isn't the same as building a speedboat.
No, it's not.
The forklift business isn't what's driving them to confidently raise full-year guidance to 15 or 16%. That hinges on the large-scale electrolyzer projects.
You're entirely right. The forklift business is survival. The electrolyzer business is the growth engine.
Which is the industrial equipment that uses electricity to split water into hydrogen and oxygen.
Right, the core tech for green hydrogen at scale. And in this report, we saw commercial momentum finally convert from a theoretical pipeline into reality. They highlighted several recent FIDs.
For those outside project finance, what is a final investment decision, an FID exactly?
It's the point of no return for massive infrastructure. The board approved the capital, funding is secured, the project is legally moving forward.
It transitions from a sales concept to contracted revenue.
Exactly. And Plug secured 30 megawatts in the UK for the Barrow Green project.
Plus 50 megawatts in Australia with Orica.
Right, the largest renewable hydrogen project to reach FID in that entire country. And a massive 275 megawatt FID in Quebec with Hytugen.
Targeting Quebec makes sense because of the incredibly cheap hydroelectric dams there.
Spot on. It's a strategic geographical play.
Yeah.
Plus, they have 100 megawatt and 25 megawatt projects commissioning right now in Portugal and Spain.
It's impressive, but it's a drop in the bucket compared to the total opportunity funnel they track, which they estimate at $8 billion.
$8 billion, yeah.
And the regulatory catalysts are massive. Europe's ARED third directive, a €780 million Dutch subsidy scheme.
And Spain's new draft framework?
Right, mandating 11% renewable industrial fuels by 2040, which alone could drive 10 gigawatts of demand. I look at all this and I think of a surfer waiting for a massive wave.
And Plug is perfectly positioned on the board.
Yes, but let me inject some skepticism here.
Go for it.
An $8 billion funnel and 2040 mandates sound fantastic on an investor slide deck. But how much of this is contracted revenue that will actually help them hit 2026 profitability versus just aspirational bureaucratic policy?
That skepticism is warranted. Converting a government mandate into an actual purchase order for plug equipment takes years.
Right.
The FIDs in the UK, Australia, and Quebec are real near-term revenue. But the broader $8 billion funnel is largely theoretical right now.
And that delay is exactly what Wall Street is worried about. Can Plug Power survive long enough to actually see those tailwinds materialize?
Because if you drown before the wave arrives, it doesn't matter how big the wave was.
Exactly. Let's look at liquidity because it's the focal point of every analyst note right now. Unrestricted cash is sitting at only $161.9 million.
Now, their total cash balance is over $670 million, but a huge chunk is restricted.
Untouchable for daily operations. It's an escrow or backing letters of credit.
Right. So to bridge the gap, management is aggressively targeting $275 million in non-dilutive liquidity through asset monetization.
Non-dilutive being the magic word. They don't want to issue new shares and crush retail investors at these depressed prices.
Exactly. And they recently received $47 million from an initial $80 million transaction. They are squeezing idle capital out of real estate and equipment.
And they desperately need that bridge capital because that raised guidance, that 15 to 16% growth and hitting positive EBITDAs relies on a heavily backloaded year.
Management explicitly stated second half revenue needs to be about 40% higher than the first half.
With the bulk in Q4, it reminds me of a college student who goofed off all semester and mathematically has to ace a comprehensive final exam just to pass.
The whole bull narrative rests on a massive, flawless Q4.
But we operate in reality, right? Supply chains break. What happens if a major customer delays readiness by 3 weeks and a chunk of Q4 slides into Q1 2027?
The entire turnaround story breaks down.
Doesn't it?
Yeah, the execution risk heading into Q4 is the elephant in the room.
Yeah.
It's why bearish analysts see up to negative 23.4% downside risk.
Because despite the margin improvements, Plug still posted a GAAP net loss of over $188 million this quarter.
Right. If Q4 slips, the cash runway gets incredibly tight, fast. They might be backed into a corner and forced into a highly dilutive capital raise.
They are betting the house that their deployment teams can handle a 40% volume spike without a single hiccup.
So as we wrap up this deep dive, we are left with two warring narratives.
Undeniable operational improvements on one side, growth margins jumping 55 points in a year, operating expenses cut in half, service margins hitting positive 27%.
The underlying business model is validating itself, but on the exact opposite side, you have a ticking liquidity clock.
$161 million in unrestricted cash.
Relying on piecemeal asset sales while they pray for a high-stakes Q4 revenue surge to push them to positive EBITDAs is the ultimate high-wire act.
It absolutely is, and that leaves you, the investor listening right now, with a fascinating proposition. If Plug Power actually pulls this off, if they ace that final exam in Q4 without diluting shares, does it fundamentally reprice the entire green hydrogen sector?
For years, hydrogen stocks have traded as speculative, high-beta tech plays based on policy headlines, not balance sheets.
Exactly. So if Plug proves that unit economics work at scale, could we finally see these companies transition into standard industrial valuations based on actual cash flows?
It would be a total paradigm shift for how Wall Street models the renewable energy space.
It's something to watch closely as we head into the back half of the year. If you found this breakdown valuable, make sure you follow the show.
We're here delivering daily earnings coverage and financial deep dives.
Cutting through the noise to get you the metrics that actually matter. We'll see you on the next deep dive.